Well, good morning from Arizona. It's probably good afternoon for many of you. We appreciate you signing up and joining us for what I think is going to be a really great webinar to help you understand what's happening with truck insurance and how you can reduce your costs. We're privileged today to have ICSA's chairman of the board, Brett Sant, as the key presenter of this information. Brett has a long background in trucking and working with identifying and reducing risk with safety and all of those things that are so important to all of us. He'll be joined by Rich Bren, who is the Vice President of Transtar Insurance. Rich is he is the newest member of our board of directors. And so I'm going to hand it right over to Brett, and I guess you'll let Rich know when he can talk, right? Thank you.
Thanks, Karen. It's our pleasure to be able to join you today and to talk about an issue I think that is very much in your minds and is something that you're dealing with constantly as you try to manage your business in what has turned out to be a historic freight down cycle. And I know that all of you are feeling that and trying to navigate your way through it, as we all are. And insurance has become one of those pain points as a cost, like fuel, like maintenance, that maybe 20 years ago you didn't think very much about. You know, it was a relatively small cost on your income statement, and today it's a much more prominent cost factor for you as a small business owner. I'm happy to have Rich joining us today. Rich has worked closely with us for a long time on our insurance program, and he comes with a wealth of knowledge of the insurance industry. And so I'm grateful that he's able to join us today. And my plan here is to go through this presentation, and you'll have access to this presentation to refer to. But really, what we want to do is tell the story, a story that you're all very familiar with because you're dealing with it, and that is the story of what seems like ever increasing premium increases, insurance increases. And we want to help you as members understand why that is happening by giving you a little bit of background about the insurance industry, the insurance market, and to add some more color about the factors that are driving the rate increases that you're experiencing. So without wasting too much time, we'll dive right in. As you know, motor carriers are responsible for providing minimum financial responsibility. In 1980, as part of the deregulation of the trucking industry, the Motor Carrier Act was passed, and part of that act was a provision that required motor carriers, both for hire and private, to provide satisfactory proof of financial responsibility. It established minimum statutory requirements that obligate a motor carrier to provide either insurance or cash or some other kind of satisfactory security to ensure that if you're operating on a public highway and something happens, there are adequate funds to compensate victims for their damages. Those minimum levels were established in 1980 and have not changed, and that is a separate subject to address, is the adequacy of these limits, which are, given the inflation that has happened since 1980, are likely not adequate to meet many of those damages that are caused on the highway. But those minimum levels are simply $750,000 for non-hazardous materials and property, or 1 million for bulk oil or hazardous waste or table 2 hazardous materials, and up to 5 million for hazardous materials, table 1 hazardous materials. These are your explosives, poison gas, and things like that. The deregulation of trucking obviously led to quite a diverse and ever-growing insurance marketplace for commercial auto. So very similar to trucking, where we have over 400 or over almost 500,000 active motor carriers. The insurance marketplace is very diverse. The top 25 commercial auto underwriters account for 68% of the market, which is more concentrated than trucking, but nevertheless, it's still a very fragmented marketplace. The largest underwriting company that writes commercial auto is Progressive Insurance, and they account for roughly 18% of the market. In our industry, there are different kinds of insurance companies, and without getting into too much detail, we've kind of bucketed them into 3 groups here for our purposes. Admitted carriers. So these are carriers who have filed rates and forms in a state where they're authorized to offer insurance. Non-admitted carriers. This would include surplus lines carriers and foreign and alien insurers. Even when you're a non-admitted carrier, you're still regulated by the state in which you're authorized to offer insurance, as say a surplus lines carrier. And there are other types of insurance providers out there, including risk retention groups and program providers that leverage captive insurance companies. And so there are a lot of different approaches that are available to insurance buyers to help facilitate your needs as an insurance buyer. Insurance companies are regulated by the states, and states can have very unique and different requirements for underwriting companies. Many of the states have very similar standards because the states are all part of a national association of insurance commissioners. And so you'll find often as you go from state to state, the states have very similar standards and requirements, but they do differ greatly from state to state. Rich, any
I just want to interject there. You know, one of your pains as you talk to your cohorts in the industry is that sometimes you start talking about maybe you're comparing rates and you don't understand why you're being mistreated, and it seems discriminatory, and that's really what insurance is. They decide if they want to do business with someone and at what cost, and based on where you live is oftentimes going to be a huge factor in the rate that you are charged. So if you are based in a New York or a New Jersey, I'll just tell you that's a high based rate, and in Florida and California. And so we talked just the other day that a large insurance carrier who does a lot of personal lines business is exiting the state of California, and their loss ratio and their experience is so bad that their AM Best rating has taken a significant drop. So those are factors that are impacting you. They're impacting us. We're consumers too. So we have auto insurance and homeowners and the like you do. But when it comes to your truck insurance, it's comparable. Commercial is looked at a little bit differently. And even if you're a small trucker, you're still in commercial insurance. So I do want to stress that sometimes you don't understand that you're being treated differently. And yes, because you're a business, and that's not meant to be mean, but commercial insurance is handled significantly different than what your personal auto or your homeowners or even your health insurance would be. So that's just something to keep in mind. And that's what we're here also to help you navigate through, is to gain some understanding.
Yeah, thanks, Rich. admitted carriers file their rates in a state. A state doesn't necessarily approve or validate the rates. They may limit your ability to raise rates, but what happens oftentimes is and this happened in California, Rich alluded to it, the admitted insurance companies were having a hard time getting the rate increases they needed to cover property losses in the state. And so many of the property underwriters have left the state of California. And the insurance company that Rich is referring to is the largest insurance company in the country. And those kinds of decisions really do influence the market really quite a bit. So if you're a homeowner in California, you're experiencing this just as a result of the large underwriting company leaving the market. And it happens in commercial auto. Underwriting companies come and go. And the amount of capacity provided to insure commercial auto is part of that economic equation that affects you kind of without really any input from us. It's just a macroeconomic factor that we don't have any control over. What tends to happen is as rates go up, more capacity enters the marketplace, hoping to be able to write profitably. Part of what's happened is we have not seen enough capacity jump in to our space to provide more capacity, and it's really because it's been very unprofitable. And we'll dive into that a little bit more. But first, we want to give you a little bit of background about how insurance companies work. Insurance companies generate profit from two sources. One is investment income. That is, you pay premiums, they pull that money, and that sits there typically in what are called investment grade securities that are very secure in order that the insurance company has satisfactory reserves to pay expected losses. So that that pool of revenue sits and earns interest. So in a rate environment like we're in today, where interest rates are high, investment income yields are higher, and so that's a positive. That's a boost to insurance companies' bottom line. But their primary source of profit is still underwriting profit, and their underwriting results and insurance companies' underwriting results drive their financial results. Certainly, again, they are helped by having high interest rates, and investment income certainly does help, but you've got to underwrite profitably over the long run, or you're just not going to be viable as an insurance company. An insurance company's key underwriting metric is what an insurance company calls the combined ratio. And Rich, you gave a great analogy about this to relate to our industry. Maybe you could talk a little bit more about the combined ratio.
I was lucky to be mentored by a guy years ago and worked for a truck insurance specialty carrier. And to understand it in your terms, it's how many pennies per mile can you make? So just like your dollar bills have 100 pennies, as do ours, insurance companies are collecting dollars to be paid out. And as demonstrated there in the buckets, the two buckets are essentially losses and expenses. And oftentimes number that's used in the industry is that 70% or 65% of the dollar goes out to pay for losses, indemnity back to you for your physical damage or cargo losses that are paid, or auto liability for damage that you've done to property or people. And then the other is the expense bucket. And so as the underwriter, the underwriting company, and insurance company is trying to do is how many pennies can we keep out of a dollar? And so you are watching your pennies per mile that you're running your trucks, right? It used to be able to use that dollar per mile, but it's no longer there, right? you can't operate at $1 per mile. You may not even be able to operate in some jurisdictions for $2 a mile. But we'll go back to $1, and it's like, if you can keep a penny, and if you can keep a penny on 1,000,000, you've accumulated something. Well, the industry has not been able to keep 1 penny. They've not been able to break even, and so you'll see that in some additional slides that follow. But just compare your businesses. You're managing your operating ratio. That's essentially what this is for them.
Yeah.
How many pennies can they keep, or fractions of a cent? That's what you're managing to in your business too.
Yeah, so think about that. Your operating ratio is basically, to an insurance company, what their combined ratio is. So it's a measure of profitability. The underwriter's job, the basic job of an insurance underwriter is to underwrite risk profitably. And that means if you have $1, you expect to underwrite that risk for, say, 55. You expect 55% of the premium to go towards paying losses, and we'll say 25% of the premium goes to cover your expenses. That is the cost to do your business, to manage your business, all of those things. So together, your loss ratio and your expense ratio may add up, in that example, to 80%. And so you would have a 20% underwriting margin before taxes and those kinds of expenses. The underwriter's job is simply to underwrite risk profitably, and they do this through a number of avenues. The first is just by deciding, okay, what risk do we really want to underwrite, and at what rate? That's the first and most important question that the underwriter has to answer is, okay, what risk am I going to underwrite, and how am I going to rate this risk? And a lot of research, a lot of data, a lot of analytics, and a lot of fact finding go into assessing the risk and rating it. The next lever that an underwriter uses to ensure that they're underwriting profitably is, once they've decided, okay, this is a risk we want to underwrite, and this is the rate we're going to charge, we also want to make sure that this company, or this trucker that we're underwriting, is doing a good job of controlling losses, of preventing losses. They may do this through loss control audits. They may do this through more engaging safety cooperation with the company, and that is quite typical, to have a loss control person from the insurance company involved, working with the insureds to help make sure we're eliminating and reducing risks. Another tool for the underwriter is claims management. Obviously, you've got to do a good job of managing and controlling claims when they do happen. So that involves working closely with repair shops to make sure that things are getting repaired timely and properly. That means working with people who are injured and their representatives to ensure that they're being cared for properly, and that their damages are being paid. So an adjuster is a claims adjuster is working to minimize the cost of claims to help ensure profitability for the underwriter. The other thing that companies do is they try to find ways to be more efficient in what they're doing, in underwriting their risk, in administering it, in just managing their business. And if you look over the last decade or so, you see, despite a lot of money spent to try and lower that cost, it's come down a little bit. I mean, insurance companies are definitely more efficient today than they were 20 years ago. And a lot of that has to do with technology. It's just much easier now to do the basic work of insurance underwriting more efficiently. And a lot of that has to do with technology.
And I want to kick in a point there. You may be looking at this as they're an adversary. I want to use this list here as a means for you to start thinking about how can you partner to help, because this is your help in this process too. And so as he speaks about effective claims management and controlling things, that's where you help in immediately reporting. That's where you help with providing key factors, key information to the adjuster. And so a lot of people look at, and I understand you're upset, and because I've done this so long and I've had my bad days, that's what I call a loss, right? That's a bad day. You didn't get out of bed that day expecting to go through that. But if you're mentally ready for it, how can you partner with the officer at the scene? How can you partner to control the scene? How can you partner to help this cargo loss from getting any worse than what it is? So those are things to keep in mind, because the underwriter ultimately is looking how that's going to play out. And so you can be looked at as a partner, a more preferred type of client too. So I just interject that right now because we're speaking from the eyes of the underwriter. I want you to start understanding how you likewise walk in the relationship with them.
Such a great point, and we really didn't highlight that in the presentation, but that is one of those things that you can do that will lower the cost of claims and over time lower the cost of your premiums, is to be very be very forthright in reporting incidents, even if they seem minor. Reporting those things as quickly as possible gives the insurance company a chance to really control the cost of that claim. If you report something late, even a few days, you've already surrendered a lot of the advantage that you have as the insurance company and the insured to manage that cost. So the worst thing that you can do is think, I'm not going to report this because it might cause my premiums to go up. That kind of thinking is really backwards. Your premiums are going to go up if you don't immediately report the loss, because that drives cost. So just keep that in mind. The best practice is to report immediately, regardless of severity, and be very detailed and forthright in the information you're providing the insurance company, because that allows the insurance adjuster, the claims adjuster, to get ahead of the claim to the greatest extent possible and to manage those costs.
I've been at this for a while, and so with the development of the box camera historically, that used to be something that we provided to truck drivers. Have your box camera ready. Well, now we all have a personal handheld device, and this is a effective claims management tool. So at the scene, if you can capture pictures immediately, if you can get some video, if you can get evidence that's really hard to debate, on what really happened, that's again a key thing that a lot of people don't realize just how valuable that can be. So that's again a demonstration of, you want the facts, right? You want the facts to be able to speak for themselves. So as we speak through these things, there's a force against all of us that we're combating. And so how can you start to find ways that you can help to control this?
And if I could add, in many cases, somebody else is videotaping what happened, just a bystander or someone else involved in a crash. So you've got to protect yourself by immediately doing the recording and then turning in the claim.
And hey, the great thing for our members is you've all committed to and invested in cameras. That is a great tool to bringing transparency to bear in all situations. And that means, hey, when you're responsible, you're responsible. But when you're not, you now have something to help show that you're not. And so we're definitely, as members of ICSA, ahead of the curve by adopting that technology and using it. But the best thing you can do with it is to be transparent. People make mistakes. That's why you buy insurance. You buy insurance to protect yourself because things do happen. And we'll get to ways we can make sure those things don't happen. But the bottom line, as you know, is your premiums are going up. This is a maybe a little bit of an eye chart, but what this graph shows is that basically from 2011 forward, every quarter of every year, rates have increased. There hasn't been a single quarter since Q2 of 2011 where insurance premiums for commercial auto have not increased. That is quite the depressing slide. Why are your rates going up? Let's get to the nuts and bolts. Your rates are going up because the commercial auto underwriters are losing money underwriting our business or our businesses. This red line is the combined ratio for the commercial auto market every year going back to 2012. You'll see as early as 2012, for every dollar of premium spent by you, the insured, the insurance company was spending almost $1.07 to handle that claim. Okay. That was as high as $1.11 in 2017. You'll see in 2021, commercial underwriters reported a profit. They eked out a profit. What's not shown there is that subsequently, in subsequent years, there have been enormous reserve increases related to 2021. What happened was during COVID, when the courts were closed and there was less traffic on the road, even though crash activity really didn't decline significantly during the year, claims were being resolved, or claims were not being resolved. And so while on paper, the commercial underwriters reported a profit, subsequently, the insurers have had to increase reserves quite dramatically for that 2021 year. So I wouldn't read too much into having one profitable year out of 11. The commercial auto underwriting has been very unprofitable for a long time, and that's why your rates are going up. This is kind of the total losses by year. On average, commercial auto has lost about $2.3 billion per year underwriting commercial auto. That obviously is not sustainable. And that is what is driving your rate increases. This slide, what I want to highlight here is you can see by the yellow line is the expense ratio. And you can see, hey, with technology over time, insurance underwriters have gotten more efficient. That's good. That helps reduce cost for us, the consumer, which is great. You can also see the red line until 2022, when we really felt the first COVID-related inflation hit. First party property damage, that is the damage to your equipment as the insured, those costs have been trending downward. So we're making progress as an industry there until inflation crept in toward the end of 2021. And you can see that, but with the red line. The blue line are liability costs. So these are losses paid to third parties under your insurance policy. And you can see this is really where the loss increase or the increased cost has come from. Over time, over the last decade, we have seen an increase in liability losses. Liability losses are driving the negative results. That's the factor that is really driving the negative the negative numbers you saw related to the combined ratio. It's liability dollars. So those are dollars paid out to third parties involved in crashes with you, the insured. So now diving deeper into why that is, why are liability dollars increasing? Why are liability losses increasing? Well, the first thing that we have to look at is frequency. Unfortunately, over the last decade, the industry has not gotten safer. In fact, when you look at fatal crashes per million miles, those crashes have increased 23% pre-COVID. Okay, there was a 23% increase over the decade from 2011 to 2020. We saw a little bit of a downtick during 2021. And I think that was related to the fact that vehicle miles traveled were significantly lower. There were fewer vehicles on the roadways. And so we did see a slight improvement in 2021, but I believe the data will show we've kind of resumed this pre-COVID negative trend since then. That is a significant factor in why we're seeing liability dollars increase, liability losses increase. We have not improved highway safety. And I will add, over that same decade, we had significant investment in safety related technologies, roll stability control systems, collision mitigation, adaptive cruise, lane departure. All of these technologies are in the truck. You would have expected with the investment in these technologies that we would start to see lower crash frequencies. And we just haven't. And there are reasons why, and we'll get into those in a little bit. But this is problem number one. We are having too many crashes as an industry. Okay. Now, problem number two is severity, and more specifically, the frequency of severity. So when I talk about frequency of severity, what I'm talking about is how often are we having serious crashes on highway? And as evidenced by the last slide, frequency has increased, and with it, the frequency of severity has increased. And in fact, it is this factor that is most responsible for the increased loss cost and the increased premiums. So not only has frequency increased, but severity has increased. That is caused by a number of factors. Foremost of these factors is the rising rate of litigation. In more and more cases, when there's a simple highway crash, victims or parties of that crash are retaining attorneys and litigating that claim, even though everyone has insurance or should have insurance, and there's coverage provided. In more and more cases, parties are choosing to litigate, and they're choosing to do that probably because every mile down the road, they're seeing a billboard advertising, hey, hire us to handle your claim. Are you a victim of a claim if you've been involved in a crash with a large truck, call so-and-so, right? You see that out on the highway. And that is definitely a factor. The advertisement, the kind of the ambulance chasing that is happening is definitely a factor. Also a factor is just the rising cost of medical care. Medical inflation is a significant factor, and frankly, related to that is it's very likely now, if you're involved in a crash, you're going to be involved in a crash with someone who is already unhealthy. Our health factors are really part of that problem. We're not as a society here in the United States very healthy, and so medical costs and the need for medical care have increased over the last 10 years significantly. The other thing that's really driving this is what we've seen, and you've heard this term, nuclear verdicts. Okay, a nuclear verdict is simply, it's kind of hard to define, but simply it's just some verdict that seems awfully high or awfully disproportionately high as to be somewhat alarming. And the frequency with which the industry is seeing nuclear verdicts has increased tremendously, particularly over the last 10 years. These nuclear verdicts are fueled by many factors, and we'll lump these into factors that we'll call social inflation. Okay, now what does that mean? Well, that means a few things. Number one, we've already mentioned that more and more cases are being litigated. Well, behind that increased litigation activity is what we'll call litigation finance. Hedge funds, private equity firms have seen, wow, there's a real opportunity here for us to invest in litigation, to finance for plaintiffs and their counsel the pursuit of damages in the courtroom, because we can afford to spend money now to try these cases. Okay, and as you can imagine, hedge funds, private equity firms are going to be very judicious about how they're spending that money. So they are working closely with plaintiffs' attorneys to identify cases where they think they have an opportunity to hit a home run in court, and they're financing that. And that is certainly a huge factor here. Along with the financing, the tactics that plaintiffs' attorneys are using to get these big damages have intensified. Okay, so in the courtroom, before you even go into the courtroom in discovery, plaintiffs' attorneys are doing everything they can to increase the value of that claim, oftentimes, frankly, by facilitating unnecessary medical care. They do this to create a higher index point for non-economic damages. The non-economic damages, which are indexed in, nominally to economic damages, such as medical care or lost wages, those non-economic damages are where they really try to inflate the value of a claim. So we've seen, and you've probably heard of, for example, reptile theory. And all reptile theory refers to is the way plaintiffs' attorneys get juries to be fearful, to think that, hey, you as jurors, you as a community, you are threatened by this behavior, and now you've got to take action, not to just address these damages here, but to punish and hold accountable those evil companies that are so dangerous and reckless. And so they use fear, and they try to manipulate juries with these tactics to grossly inflate the value of a claim. I would call many of these practices abusive or corrupt, but they work. They work because juries are susceptible to this tactic. They're susceptible to being inflamed emotionally. They want to feel like, as a jury, hey, we're doing our civic duty here and protecting the community from you, the evil trucker. Now, that isn't true, okay? Generally speaking, when there's an accident, in most cases, the accident is actually caused by the motorist. But even when the accident is caused by the trucker, it's not because the trucker doesn't care. Mistakes happen, accidents do happen. But if you're ever the unfortunate deponent or witness in a case at trial, there's no such thing as an accident. you're the wrongdoer. You're the bad guy. And the whole approach of the plaintiff's attorney is to try and get that jury to believe that you are a bad guy and that you don't care about safety. And that's what happens in the courtroom. It's a horrible thing to go through. And I hope none of you as members ever have to go through that experience. It's a horrible experience for everyone. It's horrible for the victims. It's horrible for the trucker. It's just a horrible process. Rich, anything you want to add there?
That's good stuff. You got me very fired up there. I'll share my age to a certain extent. 37 years ago, when I started underwriting truck insurance, I would say that maybe 30 years ago, working for a carrier that was writing $5 million limits on like a hazardous material carrier who hit a train. So this is a pretty severe accident, right? It was a bad day. But even in that case, I remember how diligently they worked, and that adjuster took every action that he could to settle that accident and clean up that scene for less than $5 million. Now that was a effort on their behalf. If you roll forward to today, these new terms, nuclear verdicts and social inflation. Social inflation is a word that the actuaries came up with because they weren't able to project the expected losses that are happening. That's what an actuary does, is that they look like 7 years out into the future. They're trying to throw a dart at a dartboard 7 years out into the future saying, are we getting enough premium today for these auto liability losses that are going to happen and that are going to get settled out in the next 5 to 6, 7 years? Because that's how a severe loss can really pay out over time to get settled. Do I charge enough money? Now, your cargo claims are handled usually within 6 months or less, right? Your physical damage within 30 to 45 days. But those liability losses, they're going off there. And that's where all of a sudden, historically, we looked at losses being inside the first $100,000, and then it crept up. And now where are most of the claims settled? It's no longer $100,000. It's more like a $200,000 or a $250,000 window that a lot of your claims are settling out. And now these big verdicts are coming out. And if you've read any of the industry publications that I do in the insurance space, 10, 20, 30, 40 isn't unusual. And there is a case of over $100 million judgment against a trucking company. That's insane. No one has that kind of limit. So as you look at those things, to the point made by Brett, things like soft tissue, if you hit somebody, all of a sudden, they're out rubbing their shoulders and their back, and they're going to claim soft tissue injuries. The attorneys are going to claim that they've had traumatic brain injuries, which are really difficult to try to diagnose if that really happened. It's unfortunate, but people are going under the knife, as was alluded to. They will get cut. They will take a surgery on to push up the medicals so that they can get a final bonus. I mean, really, it seems insane, but those are the sad realities of what you're up against. So again, to promote what you're doing, that you're testing, that you're using cameras and things like that, those are barriers to help protect yourself.
And to bring a fine point to that, look, if you're involved in a crash, even if it seems minor or low impact, okay, what is happening, and I mentioned the litigation finance, what is happening is that person who was involved in the crash with you, the trucker, they've seen the billboards, they make the call to the plaintiff's firm. That plaintiff's firm has relationships with doctors. They look at this and they go, oh my goodness, I'm so sorry. You're such a victim here. Let's make sure that you're okay. They then refer that accident victim to the doctor with whom they have a relationship. And they say to the doctor, look, I've been retained as counsel. We're going to litigate this. Will you provide care to my client under what's called a letter of protection? And that means, hey, you might not get paid for the surgery that you're going to perform unless we prevail, but we're going to prevail. And so the doctor agrees. And not only do they perform the surgery, they'll oftentimes perform a lot more medical care than was justified, because now they've inflated the value of the economic damages in that case. The trial attorney can then go and say, okay, here are our economic damages. I can write down on a blackboard, here's all the medical bills. Okay. The medical was provided under this letter of protection. So it wasn't provided under Medicaid. It wasn't provided under workers' comp. It wasn't provided under private insurance, all of which are negotiated at discounts with that medical provider. So the medical provider is providing the care under the letter of protection at their inflated rates. That increases the amount of the claim to start with. Then the plaintiff's attorney says, okay, well, here's our economic damages, and they're going to seek 4 and 5 and 6 times that for their non-economic damages. And that is how a case is built. So you might have what you think is a low impact case where everyone was fine at the scene, and you're thinking, well, this is nothing. I might not even report this. This is minor. And that is the mistake. You have got to assume that that other party is going to go out there, hire an attorney, and that attorney is going to work with their partner doctors to do exactly what I've described. Assume that. Now that's worst case scenario, but it's happening more and more frequently. Okay. And the litigation financing and the advertising is driving that frequency. So you have got to be prepared as the business owner to say, okay, I have got to protect myself. The best way I can protect myself is not to try and hide this from the insurance company. It's to report this to the insurance company, give them all the information they need, and let us get on top of that claim as fast as possible to prevent that from happening. Because what we can do, okay, is let's say you even report that from the scene of the accident, that adjuster can get on the phone with that other party before they've had a chance to consider that they're going to hire an attorney. And a good adjuster will get on the phone with that person and say, look, we're sorry about this. We're going to make sure we take care of you. We're going to get you in a rental car. And if you have any medical issues, we're going to help you with those. And you obviate the need in their mind, the crash victim's mind, to even go out and retain counsel. But you can't do that if the insurance company didn't know about the incident, and because that person's now feeling pain a few days later and they're desperate, they call the attorney. So that's just how the whole process works. And I think the better you understand that, the more prepared you are to help solve that problem. Now we're running a little short on time, so I want to jump a little bit ahead to 2 things. Number one is small fleets are being affected disproportionately by rising rates compared to large fleets. This is an excerpt from HRE's most recent cost study. They do a study every year that looks at the costs of trucking. This is a comparison of insurance rates for small fleets versus large fleets, and you can see there's a huge delta there between a fleet with fewer than 25 trucks or 26 trucks and one that has over 1,000 trucks. If you're running a small fleet, your costs are almost 3 times more than that of a large fleet. And there are many reasons for that, but the fact of the matter is these nuclear verdicts, these kinds of issues that are affecting everyone in the industry are affecting small fleets even more than they're affecting large fleets. And that should concern you, because we're all hauling the same freight. And that puts you at a competitive disadvantage. There are a number of reasons for this, and maybe this would be another great topic to dive into the future, but I do want you to be aware of that. And so it's really, really important for us as small fleet operators to really get engaged in solving this problem. Now, the first and most important thing we can do to solve the problem is safety. At the end of the day, I know we talked about claim reporting, and that's important, but the first thing that we've got to do is focus on safety. We have got to be part of the solution to this problem. If we don't take control of this, if that trend continues where the small fleets costs are 3 times that of the large fleets, what do you suppose happens over time to the small fleets? Think about it. It's existential for a small fleet. We've got to do this. And the thing that we've got to do is we've got to invest in safety. Safety is not an accident, okay? Safety is the result of doing the right things the right way. And there are a lot of moving pieces when it comes to safety. So the first thing that we can do is establish a fleet safety program for your business, whether you're a 1 truck operator or you've got 100 trucks. The scope of that program and the way you manage it certainly changes. If you're a 1 truck operator, hey, okay, you're going to adopt certain practices and standards for yourself. If you're a fleet operator, you're going to adopt certain practices and standards, and you're going to apply them to your business. But it's the same for everybody. The first thing you've got to do is make sure that you hire competent, conscientious drivers. Before you put them behind the wheel, make sure they're prepared. Make sure make sure you know who they are. You know that this is going to be a safe driver, and make sure that the person that you're hiring doesn't have something in their past that is going to, regardless of fault, impugn your business if you're involved in a crash with another party. Okay, if you hire, let's say you hire someone with a bad record, maybe they have criminal activity that suggests they're not trustworthy. Maybe they've been involved in crashes before. Maybe they've not had a good employment history. Maybe they don't have much experience. Regardless of what that is, when you hire that person, even if they're not at fault, their history is going to be hypercritically analyzed and torn apart. And when you've hired that person, you've made it that much more challenging for you to defend your business. So the first and most important thing you can do as a business owner is hire good, competent, conscientious drivers. The second thing that you do, and you don't need to make this terribly complicated, is you have to set expectations. You have to have standards. Those standards should address how they perform their duties behind the wheel and around the truck. What are they expected to do when it comes to speed? What are they expected to do when it comes to following distance? What are they expected to do when it comes to distractions? What are they expected to do when it comes to fatigue driving? Those standards need to be set in stone, and they have to be non-negotiable from day one with your drivers. Then you leverage your technology, your cameras, to manage performance to those standards. That is what you have got to do as a fleet owner or as the manager. Now, what we do for you is help you with that. That's to me the most important benefit of membership in this program, is that we can help you with that process. We know how to do that. We've done it for a long time, and it works. But you've got to set clear standards, and then you've got to reinforce those standards, leveraging the technology that you have in the trucks. Otherwise, you have no other way to observe the performance of your worker. The thing that's unique about the trucking industry is the people in our business performing the safety sensitive function are doing that remotely. If you were on a manufacturing floor and you were the manager, you would be able to observe directly your employees as they perform their safety sensitive functions, and you would be able to interject and intervene and make sure that they're being done safely. When you put someone out in a truck, you're not able to observe them. But with technology today, particularly with these smart event recorders, these cameras, you are able to observe performance remotely and influence that. And that is the most important thing you can do when it comes to safety. Now, there are other things. Obviously, you've got to maintain your equipment. And members of the safety association, we agree to govern the speed of our equipment. Most large fleets that I know, almost all of them govern the speed of their trucks. Now, those speeds may vary a little bit, and the way those are governed may vary a little bit, but they all do this. The reason they do this is, number one, it saves them on fuel. Number one, it is about fuel economy. And number two, it is about safety. What you see, one of those differences between the small fleet operators and the large fleet operators is the rate of what we'll call single vehicle accidents. Okay, rollovers, jackknifes, run off road type of accidents. The rate of those accidents is significantly higher in fleets that do not govern their speeds compared to fleets who do. And that is just a fact.
I'm going to interject. I think you save on maintenance costs too.
Yep.
When you slow down. So those four things that he just hit on there, those are things that are somewhat in your control, right? You can tell yourself about speeding and following distance and that. I realize you work in a ever increasingly unsafe work environment. Unfortunately, when you're out on the road, you can't control the idiot who's got a cell phone up next to their ear and they're not supposed to. And even if they have Bluetooth in, right, they are impaired. You can't control the congestion and people are taking away your safety cushion. You can't control the speed of other people and they do run into you because they're driving too fast, right? And impairment, you don't know who's next to you that's fatigued, that's high, that's stoned on something, right? So those are your defensive mechanisms. And the best that you can control is yourself and your drivers. So use those tools and enter into that unsafe work environment every day, very defensively minded, that you don't want your driver injured. You don't want your vehicle, your cargo in that, and you don't want to be a contributor to it.
Yeah. Yeah. Very good. All right. We're getting short on time. So, we're just going to follow up with a couple key points. Number one is, look, you've already joined the safety association. That to me is a significant step for a small fleet owner. Okay. You're making a commitment to safety by joining the association and agreeing to the member terms and conditions. I would urge all of you to take advantage of the benefits of membership. Use your camera system. Our safety consultants are happy to help you. Use our free online driver training. You have unlimited access for your drivers to access driver training online. You know, there are a number of benefits there that we have as members, and we're going to continue to focus on those benefits for our members. Now, lastly, the one important thing we did want to share with our membership, as you're aware, we have struggled the last few months to hold on to our insurance program partner. One of our key partners decided that they were going to exit the business, and so we've been working very hard as an organization to replace that program partner. Rich has been very instrumental in helping us do that, and we're happy to report that we've done that. We've got a new program partner who is offering auto, physical damage, cargo, general liability, all of the coverage that you've been used to having through the Safety Association. Our new partner is able to provide. Rich, do you want to talk a little bit about 180?
180 is the knowledgeable, experienced transportation underwriters. If you want to look at the number of accounts or the hundreds of millions of dollars of premium, that's impressive. Heritage goes back into, I think, 1957. So they've been around doing this. So your group, your purchasing group is still somewhat demonstrating an interest in the marketplace. So, pat yourself on the back. They're experienced, they've got the knowledge, and they're bringing you the key coverages. So keep doing the beneficial things, stay committed, and continue to control your costs, because an enterprise like 180 and possibly others in the future are going to continue to see you as being different. We talked about one of the members that called me one day and was questioning, should he continue to do these things? And I'm like, you are demonstrating yourself as being different. You're ahead of your peers, so don't stop.
Yeah.
Allow that and make sure that your underwriter knows it. And in this case, they know it because they're working with ICSA, your partner in this relationship, to help you continue to have what you need so you can keep operating.
Yeah, we're grateful to have a partner like 180. Grateful for Rich's help and now as a member of the board here for ICSA, a real knowledgeable voice about the insurance industry who can help us navigate these challenges for our members. You're putting yourself in a position long-term to be able to access more affordable coverage. There are options in the marketplace, but you have an advantage. You've already invested in the technologies. You've already invested in the practices, the drug testing, the forward-facing cameras. You have an advantage. Underwriters like 180 see you as the types of business they want to underwrite. That's a group you want to be in. When you're being evaluated as a business by auto underwriters, you want to be seen as, oh, this is somebody we want to do business with. And those who have not invested in safety, those who have not taken the time and made the effort to do the things that you're doing over time, their options are going to narrow. And these costs are going to continue to go up. Our job, our goal, what we're trying to do is we're trying to improve highway safety, not only for the sake of protecting ourselves and the motorists out on the highway, but we're trying to do this to help our small fleets, our small members compete and to be able to afford insurance coverage long term. And so these are really, really important steps to take. So my gratitude, my hat's off to you. We're very grateful that you have chosen to participate in this program. And I look forward to continuing to work on your behalf to help us achieve these goals, to be safer and to be able to afford coverage and compete with everyone else in the industry. So with that, I know we're running up against time. I think we'll open it up for a couple minutes. If anyone had any questions they wanted to ask, we're happy to try and answer your questions. And if no one has any questions, that's great.
And for those of you, I know many people watch these recorded webinars when they're in a place where they can do that. If you have questions, you can contact us by simply sending an email to contact@safecarriers.org, and we will get back to you within 24 hours with an answer to your question. So you have just as great an opportunity as people who are currently on the webinar chat.
Yeah, I see we've only got a handful of attendees, so I hope that we can get the word out to our members and let them access this recording. I think there's a lot of information here that can be useful to you in understanding what's happening to your business. And appreciate everybody attending. So thank you for joining, and look forward to seeing you at our next webinar.
Thank you, Brett, and thank you, Rich.